Right, so let's begin with our discussion on the 800 series, right? Starting with essay 800 special considerations, audits of financial statements prepared in accordance with special purpose framework, right? Then after that, the essay 805, which is audit of single financial statement specific element, account or item of the financial statement, right? So specific element, it could be account or the item of the financial statements. And then essay 810, engagements to report on the summary financial statements, right? Summary financial statements. Okay, now the first point of distinction that we need to understand in these three standards, like in 800 we are talking about the special purpose framework, but obviously there could be financial statements first also prepared under the general purpose framework. So general purpose framework financial statements are for the common users, for the wide range of users, and special purpose financial statements are for a specific set of the users. Okay, now say the person who is doing the audit of the general purpose financial statements is PwC. So now special purpose financial statements, they could be audited by PwC or they could be appointed or audited by KPMG. That means for the purpose of SA 800, it could be the same auditor or it could be a different auditor. Then for the purpose of the SA 805, to do the audit of the complete financial statements and full financial statements, say PwC is appointed. And now second, what is to be done is an audit of the part of the financial statements. So now to do the audit of the part of the financial statements, PwC could be appointed or KPMG could be appointed. That means here also it could be the same auditor or it could be a different auditor. Some another auditor could be doing the audit of the part. Now, in essay 810, there is one CA who is doing the audit of the entire financial statements, audited financial statements, say PwC. And now the report is to be given on the summary financial statements, and only PwC can give a report on the summary financial statements. That means for the purpose of SA 810, it has to be the same auditor. For the purpose of 800 and 805, it may be the same auditor, it may be a different auditor. Okay, to audit general purpose, you appointed PwC. For special purpose, you appoint PwC, you appoint Deloitte, any other firm. Okay. 805 also could be the same auditor who is doing the audit of the complete financial statement. Same auditor could be doing the audit of the part, or it could be a different auditor. But for 810, what is the condition? Only the auditor who has done the audit of the audited financial statements, who has given a report on the audited, the complete financial statements, only that auditor can give a report on the summary financial statements. So for the purpose of SA 810, it has to be the same auditor. Okay, right. You remember today I discussed with you SA 210, the preconditions for an audit. How many preconditions were there? 1 plus 5, 6 preconditions. Do you remember the first giant precondition? What was that? The acceptability of the AFRF, that whether the AFRF being used by the management in the preparation of financial statements, is that acceptable to the auditor. Now for 800, 805, is the same precondition going to be there? Special purpose framework, is that AFRF acceptable? Yes. For 805 also, okay, for a single financial statement, that only balance sheet, is the AFRF acceptable? Or only debtors, for that is the AFRF acceptable? Yes. But now for 810, there is no question of acceptability of the AFRF. Now for 810, wherein the management has now prepared the summary financial statements. So just like for preparation of financial statements, AFRF is required. Similarly, for preparation of the summary financial statements, what is required is the applied criteria. So now in case of 810, what is going to be the giant precondition over there? The acceptability of the Applied criteria, exactly. The acceptability of the applied criteria. And you will go nuts listening to the definition of applied criteria. You will go crazy listening to the definition of applied criteria. What is the definition of applied criteria? The criteria applied in the preparation of summary financial statements. So obviously, what you have to check in case of summary financial statements is the acceptability of the applied criteria. So like today morning, I discussed with you independence. And what did I say? The moment you listen to the term independence, the next word coming to your mind has to be whether there are any threats to the independence of the auditor. Similarly, now the moment you listen to the term summary financial statements, the next term coming to your mind has to be the applied criteria, the criteria applied by the management in the preparation of the summary financial statements. Okay, so did you get the takeaways? One, for 800, 805, it could be same, it could be different. For 810, it has to be the same auditor. For 800, 805, we check the acceptability of the AFRF. For 810, we check the acceptability of the applied criteria. And now for all these three standards, that is for 800, 805 and 810, rather all the 10 standards which I'm going to discuss with you right now. First, we have to discuss the example or the meaning. Okay, you know what you mean by special purpose framework, what do you mean by audit of a part of the financial statements, or what is meant by summary financial statements. That is the part one of the standard. That is the introductory part of that standard. And then after that, in each and every standard, we have to discuss APR. What is APR? The accepting the engagement. Then once you decide to accept the engagement, then planning and performing the engagement. And once you plan and perform the engagement, then you have to issue the report, right? So we are going to talk about the reporting. Right, so if you look into the format of these three standards, you'll find them flowing in the same manner. Okay, there is some introductory content given over there, then there is some acceptance ka point, then some procedure ka point, and then there is the reporting. Right, that is what we need to discuss in each of these standards. Is it clear to everyone? Okay, right. So now acceptance of the engagement. Now let's first finish with our discussion on SA 800, which is for the special purpose framework. That means financial statements are being prepared for a specific set of users. That means say they are prepared as per the provisions of a contract, or they are prepared as per the requirement of the government, or they are prepared as per the requirements of the creditor, or to meet the requirement of a regulator. That means for a specific set of users, for a particular purpose, when the financial statements are being prepared, then that is the example of a special purpose framework. So the first question which I expect to see in your exams is regarding the examples of special purpose framework. What did I tell you? In all the three standards, what we have to discuss? Acceptance, planning, performing and reporting, right? Acceptance, planning, performing and reporting. So now SA 800, when financial statements are prepared for meeting the needs of the specific users, then that is special purpose framework. That means say creditors of the company, regulator, provisions of a contract, bond indenture, loan agreement, project grants for a specific set of users. When the financial statements are being prepared, that is an example of special purpose framework. Okay, and now we will talk about three things. Which three things will we talk about? Acceptance, planning, performing and reporting. So obviously in the exam there could be a direct question at the wholesale level for any one of them, or some case study or MCQ question. Okay, right. Now considerations while accepting the engagement. So like if I look at your RTP May 24, they say that the company is preparing the financial statements as per the Dutch gap. Right, they got some Dutch gap over there. Right, so obviously when you see this Dutch gap, you know it has to be a special purpose framework. So see, if a company prepares financial statements as per Ind AS and Schedule 3, very normal, no, obvious. It's a general purpose framework, no big deal about it. Indian company prepared financial statements as per Ind AS and Schedule 3. But Indian company prepared financial statements, Amrita Industries prepared their financial statements as per Dutch gap and the terms conditions specified in the contract. That means I told you, example of special purpose framework, they are prepared as per the provisions of a contract. They have been prepared as per the provisions of a contract, right? So now obviously that means it's a special purpose framework. So now client has prepared financial statements as per Dutch GAAP and they are telling CA, please accept this engagement and do the audit of these financial statements. I have to think whether I should accept this engagement or not. So obviously, what are the considerations while accepting the engagement? One, who are the intended users? So is it that they are preparing financial statements as per Dutch GAAP? Because as per Dutch accounting policy, it shows a higher profit, and that higher profit financial statements they are going to submit to the Indian Stock Exchange, then it will be a wrong thing. Right? So first thing you have to understand is who are the intended users. Then whether that special purpose framework, is it given by any law regulation or is it as per the provisions of any contract? So Dutch GAAP, obviously it's a law. But if it is prepared as per the provisions of a contract, as per a government indenture or so, then it is as per the provisions of a contract. Right, so you need to check who are the intended users. Then is it given by any law or regulation or is it as per the provisions of any contract? Right, and then whether the AFRF is acceptable or not for the auditor to decide that, what does it say? It's a matter of the professional judgment of the auditor. It's a matter of the professional judgment for the auditor. Right, so acceptability of the AFRF, right, are supplemented by legislative regulatory requirement. SA 210 requires the auditor to check whether there is any conflict between the financial reporting standards and the additional requirement and what actions have been taken if there is a conflict. Right, so laws, regulation, then if there is any conflict, then whether it is as per the provisions of any contract and whether it is acceptable or not, determining that is ultimately a matter of the professional judgment for the auditor. So in the exam, if you see a question regarding the accepting the engagement for SA 800, the only points which you have to write in your answer is who are the intended users. Is it as per any law regulation? Is it coming in conflict? Is it as per the provisions of any contract? And whether it is acceptable or not is a matter of the professional judgment. No writing anything apart from this. Right, in your answer. Okay, then after acceptance is over, now next what you need to do? Plan and perform the engagement, right? What standard are we discussing right now? SA 800. That means we are still doing an auditing standard only, right? But only difference ke instead of financial statements prepared as per a general purpose framework, now the financial statements have been prepared as per a special purpose framework. So the title of SA 200, overall objectives of the independent auditor and the conduct of an audit in accordance with the standards on auditing. Right, so now when I'm doing audit of financial statements prepared in accordance with special purpose framework, do I need to comply with the ethical requirements including independence? Yes. Do I need to comply with all essays which are relevant to the audit? Yes. When do I don't need to comply with an essay? One, if the essay is not relevant or the requirement is conditional and the condition does not exist. Like, 299. I'm appointed as a sole auditor. So obviously, is 299 relevant? No. If I'm using the work of an auditor's expert, then I have to follow essay 620. If I'm not using the work of an expert, then do I need to follow 620? No, that means it is conditional and the condition does not exist. Then it says you don't need to follow. Then any particular essay you're not able to follow, then what you do? Do you try to perform the alternative audit procedures? And still if there is a departure, you will mention it in your audit report. Now, I am doing the audit of financial statements which the management has prepared as per a special purpose framework. Should I determine materiality? I am doing the audit of financial statements which the management has prepared as per a special purpose framework. In that case also, do I need to consider materiality? Yes. How do I determine materiality? As per SA 320. And materiality in planning and performing an audit. Okay. Now, say the financial statements are prepared as per the special purpose framework, and in that special purpose framework, the threshold, a different name of materiality, the threshold of materiality has been given under the special purpose framework. And okay, the level of materiality has been given, in the contract it has been given, okay, the materiality amount is to be taken as $1,000. It's given in the contract. Right. So now, when the level of materiality has been given in the special purpose framework, still do I need to consider materiality as per 320, or now I need to only follow the level of materiality which is given under the threshold they given under the contract? Okay, right. So let's look at a question in the RTP May 24. Right, so one of the terms and conditions of the contract was to get the financial statements audited from an independent auditor. The contract also stipulated auditors to take account misstatements of 5,000 euros or more while framing their opinion. So has the threshold of materiality been given in the special purpose framework? Yes. Now, any misstatements identified below this threshold does not require correction or adjustment in terms of the stipulation in the contract. While planning the audit, the auditor had also determined performance materiality at 10,000 and overall materiality at 2 lakh. Okay, and then the following information has been given. Right, so that's the question regarding internal audit, so that we shall see it later. But now this part of the question. If the audit team of BCD and company were not sure which materiality to choose to evaluate the effect of the identified misstatements on the audit and of the uncorrected misstatements, if any, in order to form an opinion and to conclude whether the auditor has obtained a reasonable assurance that financial statements are free from material misstatement. You are required to guide the audit team by selecting the appropriate option from below. In case of special purpose financial statements, management may agree with the intended users on a threshold below which misstatements identified will not be corrected. The existence of such a threshold does not relieve the auditor from the requirement to determine materiality as per 320. So it says, please consider the threshold, but also consider the level of materiality in SA 320. Okay, then in case of special purpose, management may agree with the intended users on a threshold. Existence of such a threshold is sufficient to comply with the requirement of materiality as per 320. So it says if you follow threshold, then you automatically follow 320 also. Then in case of special purpose, misstatements based on consideration of financial information needs of the users are considered material and pervasive. However, the auditor needs to follow the threshold limit provided in terms of the contract, and such threshold will also be considered as performance materiality for planning and performing. So again, what they are saying, only the threshold has to be considered, and the auditor is required to comply with each requirement of an SA unless that SA is not relevant or the requirement is conditional and the condition does not exist. In the case of audit of special purpose, the requirement of 320 is not applicable in the entirety. So it says 320 not applicable only, right? So obviously, which is the correct option over here? A. But see, again, what is it? It's an application of the concept. I told you, you read even 4 lines in the book that has a concept hidden over there, and that concept comes as a question in the exam. Okay, though you determine consider the level of materiality given in the threshold, that does not free you from the responsibility of complying with the requirement of materiality as per 320. Okay, now generally what we say, okay, preparation, presentation of financial statements is the responsibility of the management. And who oversees this preparation, presentation of financial statements? The TCWG. And they oversight, they are the highest level of management. So what does 800 say? That such oversight responsibility may not exist in case of special purpose framework. Okay, TCWG, generally they oversee the preparation of financial statements, but they may not have that oversight responsibility in case of the special purpose framework. And ultimately, what does it say? Auditor, when you have to form your opinion, you form your opinion as per SA 700. And what did I teach you today? That forming an opinion is an art. Forming an opinion is an art. And if it is fair presentation framework, then also the PP. Right? Structure, presentation, content, and it achieves a fair presentation. Right? So this is planning and performing. Right? So this is the second part of the standard, which says that auditor, you need to comply with the ethical requirements, comply with all SA unless the SA is not relevant or it is conditional. If you depart from the requirement of an SA, you need to perform the alternative procedures. Then will you consider materiality as per 320? Yes. What if the threshold of materiality is given? It does not relieve you from complying with the requirement of 320. Then what does it say? TCWG may not have the oversight responsibility in case of the special purpose financial statements, and you have to form your opinion as per SA 700, right? That is planning and performing. And then third part over there is the description, right? Because now the financial statements have been prepared as per a special purpose framework. So one auditor, what you do in your audit report, either you write the purpose and the intended users, or you make a reference to the note in the financial statements where this purpose and intended users have been given. So either in the audit report, auditor, you write down the purpose, why the special purpose financial statements are being prepared, and you also write down the intended users. Or second option, you don't write it in the report, but you make a reference to the note where this purpose and intended users have been given. So when I make a reference to the note in the financial statements, that comes under emphasis of matter or other matter? When I can make a reference, you remember everyone, emphasis of matter, other matter. Yes, heading emphasis of matter. Second, clear reference to financial statements and without modifying the opinion. And other matter, only the heading is other matter. So if I make a clear reference to the financial statements, that means it comes under the emphasis of the matter paragraph, right? So one, you make the write the purpose, intended users, or you make a reference to the note and say management had a choice of AFRF, that they could have used Dutch GAAP or US GAAP or Australian GAAP or Hong Kong GAAP, Chinese GAAP, Japanese GAAP. So many GAPs option they had. Out of that, how they selected a particular GAAP, the choice of AFRF, also how that choice was made, again that has to be mentioned in the report. If they had a choice like that, they had 6 AFRF, out of that they had to select any one. So how management made the choice of AFRF, that explanation also has to be given in the responsibility, that how management determined the acceptability of the AFRF. Now these financial statements, like say which are prepared as per the Dutch GAAP, has been prepared by the management for a specific set of users. So should it go to all the shareholders of the company? No, they are prepared for a specific purpose, for a specific set of users. So very clearly, auditor, in your audit report, you have to write down what? These special purpose financial statements may be used for another purpose. So to avoid misunderstanding, the auditor alerts the users of the audit report that the financial statements are prepared as per a special purpose framework, and therefore they may not be suitable for another purpose. They should not be used. They are only used for the consolidation purpose, only for the contract, and should not be used for any other purpose. And again, mentioning that the report is only for a specific set of users, right? That the report is only for a specific set of users, right? So that's our discussion first on the SA 800, right? So test your understanding. See, Lalita is the auditor of a company. She is also offered professional work of audit of financial statements prepared as per the requirements of a loan agreement. She chooses to accept the work and keep the matter, put the matter in her audit report under the other matter paragraph. Is her approach proper, right? So what does it say? She has intended to disclose the fact in the other matter of the audit report, saying that it is only for a specific set of users, right? So if you make a reference to the financial statements, then emphasis of matter. But if you're just saying that it is for a specific set of users, so that's related to the audit and the auditor's responsibility, then you put it under the other matter. Okay. Lakshmi has prepared a draft audit report for financial statements of X, prepared in accordance with the provisions of a contract. She has drafted an unmodified opinion, and she has also drawn attention in the draft audit report to note A, to the financial statements which describes the basis of accounting. Draft a suitable paragraph to be included in the audit report, right? So what does it say? Without modifying our opinion. So that's the emphasis of matter. We draw attention to note A, to the financial statements which describe the basis of the accounting. The financial statements are prepared to assist the company to comply with the provisions of the contract. As a result, the financial statements may not be suitable for another purpose. Our report is intended only for X Limited and Y Limited and should not be distributed to or used by parties other than X and Y. Right? So can these questions be coming in your exam? The question number 1 and 2 from the test your understanding? Yes. Right? So that's our discussion on SA 800, special considerations, audits of, yes, financial statements prepared in accordance with the special purpose framework, right? Special purpose framework. Okay. Next standard which we have over there is the SA 805, right? Special considerations, audits of single financial statements, specific element, account or item of the financial statement. Can it be the same auditor? Yes. Can it be a different auditor? Yes. Now, say example, I have only done the audit of the entire financial statements and they are telling me now give us a report on debtors only. You'll say, what's the big deal? Anyways, I have done the audit of your entire financial statement. For each and every item account, I can give you a separate audit report. It says no. You will create a separate audit file, separate bill, separate, and you will consider it to be a separate engagement. But can you use the work which you used in your audit of entire financial statements while doing the audit of the part? Yeah, that is possible if it is the same auditor. But if it's a different auditor, then we will consider the situation over there. And that's a very, what you say, difficult situation to tackle. Okay. Now, so example, they are telling me, CA, we want you to do the audit only of our debtors. And they say only, CA, pura audit, nothing to be done. Example, only debtors you audit. CA says, no problem, I will audit only the debtors. So CA says, give me the information regarding debtors. So they take a small piece of paper and on that paper, they write Geo Limited debtors, 10,000 crore rupees. And that small piece of paper, litmus paper type, they're roaming around and telling CA, CA audit this, CA audit this. CA reverses the paper on the backside, writes no and returns it back. I understand that you want me to do the audit only of debtor. But regarding the part, the information should be given in full. It should provide a structured presentation. You can't go roaming around everywhere to debtor audit, debtor audit. No. Okay, only debtor, but debtors you give now more than 6 months, less than 6 months, considered good, considered doubtful, secured, unsecured. Right? Then also the related party debtors, then the provision for bad and doubtful debts. You give all this data, no? Don't roam around everywhere saying that debtor 10,000 crore, debtor 10,000 crore. No. Then, can it so happen that these debtors ka audit which is to be done, management has prepared as per Ind AS and Schedule 3. So then it will be a combination of SA 805 and our normal all other standards on auditing. But say management has prepared information only of debtors as per Dutch GAAP. So now it's going to be a combination of 805 plus SA 800 and then comply with all essays which are relevant to the audit. And adapt all essays as required. Because now it is part also plus it is special purpose framework also. So then you will have to follow SA 800 also and 805 also, right? They've made a question on this one. In this situation, you have to follow both 800. You follow what I say, right? You follow, right? So in that case, you have to follow both 800 as well as the SA 805. Okay, right. So now first we talk about the single financial statement, right? So the considerations again for acceptance, then planning, performing, and then the reporting. Okay, right. So what could be a part of the financial statement? Only debtors, only externally managed assets, or only the tangible assets, or only the lease property. Right? So anything where they are telling you to do the audit of a part of the financial statement, or do audit only of the cash flow statement, or only of the element account or item, like only trade receivable, only cash and bank or so. Right? Again, what do we talk about is the acceptance. Now you're in the acceptance that say, will you comply with all essays relevant to the audit? Yes, because again it is SA 805. Now, what is the complicated situation over here? Okay, one, you are engaged to do the audit of the complete set of financial statements also, or you are not engaged to audit the complete set of financial statements. That means entire financial statements are being audited by PwC, and say for doing the audit of debtors, they are appointing the KPMG. Example. Right? So you have not done the audit of the complete financial statements. Do you need to comply with ethical requirement? Yes. Do you comply with all essays? Unless an essay is not relevant, or the requirement is conditional and the condition does not exist. And if there is a departure, then you perform the alternative audit procedure. Okay, now we talk about that situation when you are not appointed to do the audit of the complete financial statements. You're not engaged to do the audit of the complete, but they are telling you do the audit only of the balance sheet or do the audit only of the debtors. What does it say? Such type of an engagement may not be practicable. And so this is where they are asking the case study in your exams. Okay, entire financial statement, say who is auditing? PwC, and say to do the audit of debtors who they've appointed? KPMG. So what KPMG may consider, it may not be practicable to do the audit when he is not engaged to audit the complete set of financial statements. Why it may not be practicable? One, because you don't have the same understanding of the entity and its environment. Second, you don't have the evidence about the general quality of the accounting records. And see, if I'm doing audit only of debtors, from the perspective of debtors also, do I need to check going concern? From the perspective of debtors also, do I need to check subsequent events? So just for doing the audit of that one debtors, it says disproportionate work may be required to be done. Like just to give the opinion on debtors, are they true and fair? It says disproportionate audit work may be required. And if the CA so thinks that it may lead to the disproportionate audit work, he may request the client to appoint him for another type of engagement. Yes, which might be more practicable. So you can tell client, at least appoint me for single financial statement or entire financial statements, or tell PwC only to do the engagement, right? So another type of engagement which would be more practicable, right? So from not practicable, what do you reach to? What is more practicable? What do we start with? Okay, it may not be practicable if you're not doing the audit of the entity. Why it may not be practicable? Because you don't have the understanding of the entity and its environment. You don't have the evidence about the general quality of the accounting records, and the work which may be required to be done could be disproportionate. Okay, just for one debtor, you checking all the auditing standards, it says might be disproportionate. And then in that case, what can you tell the client to make it practicable? To do another, right? Another type of engagement which might be more practicable. Right? So this is a case study which we expect to see in the exam. Right, then what did I tell you? Though it is debtor, regarding the part, the information should be given in full. They can't roam around everywhere with one small chit of paper saying debtor 10,000 crore. So again, for the part, will I check the acceptability of the AFRF? Yes, and though it is only a part, it should still provide the adequate disclosures. It should still give the structured presentation, right, regarding that part of the financial statements. Otherwise, CSA is not possible. I cannot accept this engagement. And then now we come to planning and performing. What did I tell you? Each standard, what we have to discuss? Acceptance, planning, performing, and reporting. Now, in SA 800, what did we say? Comply with all essays, comply with all essays which are relevant to the audit, unless that essay is not relevant or it is conditional. Now in SA 805, what does it say? Adapt all essays which are relevant to the audit. Okay, while doing the audit of debtor or inventory or rent, it says whichever essays are relevant, you adapt those essays which are relevant to the audit. Right? So there in 800, what do we say? Comply with all essays. Here, what do we say? Adapt all essays which are relevant to the audit. And regarding that part, what does it say? You obtain the sufficient appropriate audit evidence. Then, what does it say? Some items, you cannot do the audit of them in isolation. So you might have to do the audit of the interrelated items together. Like, if I'm doing audit of debtors, you say, Aarti, you are appointed to do audit of debtor. Why you're checking provision for bad and doubtful debts? Will I have to check provision for bad and doubtful debts? Why? Because it is an interrelated item. And again, what does it say? When you're appointed to do an audit of a part of the financial statements, the level of materiality which you will decide will be lower than the materiality for the complete financial statements. Because obviously for full financial statements, materiality might be 10,000, but for debtors, materiality may be 2,000. Right, so specifically, we can't beat around the bush. We can't write anything in our own words. So in the exam, if there is a question, how do you perform the engagement to do the audit of a part of the financial statements? First point, you say you adapt with all essays relevant to the audit. You obtain the sufficient appropriate audit evidence. Then you also might have to check the interrelated items. And then finally, what does it say? That auditor, the materiality level may be lower when you're doing an audit of a part of the financial statement. Right, and then we come to the reporting, right? So planning, performing, and then we come to the reporting. Form and opinion. For fair presentation framework, true and fair view. For compliance framework, prepared. Right? Compliance framework, prepared. Okay. And now, whatever is written in the book over the next 1 or 2 pages, you have to listen to these 4 points which I am telling you. And this is where the institute has put the next MCQs in your paper. And in the RTP May 24. Listen to me carefully, right? One time, not expected that you will remember or you will understand, but if you understand, that's very great. If the auditor's opinion, right? So there is a general rule. What is the general rule? If the auditor's opinion on the audited, or I can call it as CFS. What is CFS over here? Complete financial statements is the modified opinion, or it has an emphasis of matter or other matter. It says now auditor, when you're doing an audit report on the part of the financial statements, one, you will state that the audit report on the audited financial statements contains a modification. Second, you will copy paste the basis for modification opinion paragraph. And third, you will consider the effect thereof on the summary, the effect, whether it is appropriate to modify the opinion for the part also. So if deemed appropriate, what does it say? Modify the opinion for the part also. What does it mean? Okay, my auditor's opinion on the audited financial statements is a qualified opinion due to inventory, which I say is overvalued by 20 crore. Now, in the part, I have been appointed to do the audit of debtors. For debtors, can I issue an unmodified opinion? For entire financial statements, my opinion is qualified due to inventory. I say true and fair except for inventory. Now, in part, I am appointed to do the audit of debtors. For debtors, can I issue unmodified opinion? Yes, for debtors, I can issue the unmodified opinion. But in say part, I am appointed to do the audit of inventory. Then for inventory, can I issue unmodified opinion? No. You understand? That is why, what is the wording over there? If deemed appropriate, you modify the opinion for the part also. Okay. Now, the auditor's opinion on the audited financial statements is qualified due to inventory. And here in the part, I am appointed to do the audit of debtors. Okay. Now, is this inventory qualification related to the part? No, because in the part, I am appointed to do the audit of the debtors. But should the audit users of the audit report of part be aware that there is a qualification in the main audit report regarding inventory? So you might consider it to be relevant, though it is not related. So in that case, you may put it in your audit report under the other matter paragraph. In the main audit report, it's given by way of a modification, but in the audit of the part, you're putting that same qualification now as a other matter. Why? Because it's not related to the debtor. It is related to the inventory, but you think it is relevant to the user's understanding. So then you may put it in the other matter paragraph. That is the point number 2. Right? If the auditor's report on the complete financial statements has a modified opinion and you think that modification is not related to the part, but you think it is relevant to the part, then now in your audit report of the part, you may put it under the other matter paragraph. You may put it under the other matter paragraph. Then point number 3. Now, what is the point number 3? It is the exception. What does it say? If the auditor's report on the complete financial statements is an adverse or disclaimer. So now this was the general rule, if deemed appropriate. Now what does it say? If the auditor's opinion on the complete financial statements is an adverse, not a true and fair, or disclaimer, we are not in the position and we do not express an opinion, then what does it say? Single financial statement, unmodified opinion can never be issued, even if they are not published together. Why? Because see, entire financial statements, I am saying adverse opinion, not a true and fair. And here I am appointed to do the audit of the balance sheet, single financial statement. Can I say entire financial statements not true and fair, but balance sheet is true and fair? Are you not contradicting your own adverse opinion on the complete financial statement by giving an unmodified opinion for a single financial statement? Single financial statement. So what does it say? If the auditor's opinion on the complete financial statements is adverse or disclaimer, single financial statement, unmodified opinion, don't even think about it. You say they are not published together. It says even then, no. An unmodified opinion for single financial statement can never be issued if the auditor's opinion on audited is adverse or disclaimer. However, what does it say for specific element? That means for a small part. A specific element, account or item, what does it say? Still an unmodified opinion can be issued, provided it is not prohibited by law. They are not published together and it does not constitute a major portion, right? Then it says for a specific element, account, item, you can still issue unmodified opinion. That means if auditor's opinion on the audited financial statements is adverse, single financial statement, unmodified, no. But only for debtors can you still issue an unmodified opinion. It says yes, but subject to 3 conditions. What are the 3 conditions? Not prohibited by law, not published together, and it does not constitute a major portion. So what is point number 3? If the auditor's opinion on the audited financial statements is adverse or disclaimer, single financial statement, unmodified opinion, don't even think about it. Specific element, you can think about it, provided these 3 conditions are fulfilled. Okay. Now, to the exception, there is one more exception. Okay, if the auditor's opinion on the complete financial statements is a disclaimer. On the complete financial statements, auditor has said, disclaimer, we are not in a position, we do not express an opinion, and this disclaimer is due to profit and loss and cash flow statement. It says for single financial statement being a balance sheet, unmodified opinion can still be issued. Because your disclaimer is due to profit and loss and cash flow. So it says what is the mistake of balance sheet? For balance sheet, you can still give an unmodified opinion. Right? So the entire story which you read in the study material or in our books, ultimately this is what are the 4 points that they are talking about over there. First they say if deemed appropriate. Then they say it's not related but it is relevant, put it in other matter. Then they say adverse disclaimer, then don't even think of an unmodified opinion. But it says for specific elements subject to 3 conditions. And then to the exception. Yes, what did they say? Complete financial statements, if it is a disclaimer due to profit and loss or the cash flow, it says single financial statement being the balance sheet, still an unmodified opinion can be issued, right? Let's come to the RTP May 24. Right, those are the specific questions that they have put over there. Okay. Right, this is the question on Manish, the audit manager of BCD, objected to the insertion of other matter paragraphs for the special purpose framework, right? So special purpose framework, you have to put the paragraph saying that emphasis of matter, they may not be suitable for the another purpose. And then Chitrang, right? The audit manager at BB, an associate chartered accountant, is seeking your guidance in drafting the separate opinion on cash flow and other financial statement. Guide the audit manager by selecting the appropriate option from below. Right? So now what does it say? Separate opinion for the cash flow and the other financial statements. When the auditor considers it necessary to express an adverse or disclaimer on the financial statements as a whole, the auditor's report shall not include an unmodified opinion with respect to the same IFRF on a single financial statement, specific element, account, or item. The expression disclaimer of opinion regarding the results of operations and cash flows when relevant, and an unmodified opinion regarding the financial position is allowed. In this case, the auditor has given a disclaimer of opinion on the financial statements as a whole and a separate opinion on the cash flows. And then the expression of an unmodified opinion on financial statements prepared under a framework and within the same report, the expression of an adverse opinion on the same financial statements is permissible? No. And an adverse opinion or a disclaimer of opinion relating to a specific matter described within the basis for opinion section does not limit the auditor's responsibility to issue an unmodified opinion. No. So what are they talking about over here? If the auditor's opinion on the audited financial statements is adverse or disclaimer, for a single financial statement, unmodified opinion cannot be issued. However, what do we say? Specific element, account, item? Yes, provided it is not prohibited by law, not published together, or does not constitute a major portion. Right? So if you think, oh my God, 800 has just become applicable and institute will be merciful with asking the question, look at the ruthlessness. It's the opposite of mercy, where they are asking the questions in that too and obviously questions in the exams are 10 times higher than the questions which are there in the RTP. When it comes to the level of complexity and so. Okay, right. So that is our second standard. So the purpose of the class or our discussion today is what? For you to become familiar with these standards that we are talking about over here. So that's the entire story. I told you, if deemed appropriate, modify the opinion for the part, right? And then these entire points given over here. Okay. Right. Now coming to the next standard over there, which is the engagements to report on the summary financial statements. Tell me the two important things which you will remember for SA 810. Engagements to report on summary financial statements. What are the two things you will remember over there? One, it has to be the same auditor, and second, we have to check the acceptability of the applied criteria. What is applied criteria? The criteria applied by the management in the preparation of the summary financial statements. Okay. Now, right, summary financial statements. Okay. So these are the audited financial statements, and then these are the summary financial statements. So obviously the same auditor, what he has to check, that whether the summary financial statements, are they properly derived from the audited financial statements? Are they properly derived from the audited financial statements? Okay. So for audited financial statements, what you could say, that they are true and fair, or they are prepared in accordance with the AFRF. Now for summary financial statements, what auditor will express an opinion saying that these summary financial statements are a fair summary of the audited financial statements, or these summary financial statements are consistent with the audited financial statements, right? So for fair presentation framework, you will say that they are a fair summary, and for the compliance framework, you will say that they are consistent with the audited financial statements, right? So this is the form of your opinion. Either you say fair summary or you say they are consistent. Okay, right? Fair summary or consistent. Again, in this standard, what we have to discuss: acceptance, procedure, the procedures for reporting on summary financial statements, and then the reporting, planning, performing, that is procedures, and then we have to discuss the reporting. Okay. Now for acceptance, what is going to be the giant precondition? Giant precondition, the acceptability of the applied criteria. Now, once the applied criteria is acceptable to the CA, who is going to prepare summary as per that applied criteria? 100% it is the responsibility of the management. So preparation and presentation of summary financial statements in accordance with applied criteria, whose responsibility? Management. It is your responsibility. And last one is the form of opinion, the expected form and content of the report. What did I tell you? Expected form and content of the report: fair, summary, or consistent. and a fair summary, or it could be called as the consistent, right? So these are the three considerations while accepting the engagement. So what did I tell you? Summary financial statements are they derived properly from the audited financial statements. And what is summary? Which contains less detail, right, than the audited financial statements. And before accepting the engagement, what is the first giant precondition? Whether the applied criteria, is it acceptable? Right? So applied criteria, what is the definition? The criteria applied by the management. Who is responsible for determining the applied criteria? Management. Right? So the management has to check that though it is the limited disclosure, there is an increased risk that it may not contain all the information. And how do you check the acceptability of the applied criteria? We have a retail question over there. They say, oh, this is the criteria which we've applied. This all information we will not give, this which information we will give, and we will prepare summary. Right? So the acceptability of the applied criteria depends on the nature of the entity, the purpose of the summary financial statements, the information needs of the users, and it will result in summary financial statements that are not misleading. Right? It will result in the summary financial statements that are not misleading, right? So no surprise if I see a retail question in your exams on this one. Right? That as an auditor, I told you there are three conditions. What are the three conditions? Acceptability of applied criteria, preparation of summary as per applied criteria, and the form of opinion. But the first one could be a retail question in your exams, that how do you determine that whether the applied criteria is acceptable or not? So what do you look into? The nature of the entity, the purpose, then the information needs of the users, and also the result of summary will not result in financial statements which are misleading, right? They should not be misleading in these circumstances. Okay, right? And then some applied criteria could either be given by law or it could be developed by the management. So like, the applied criteria, it could be abridged financial statements as required by SEBI. So then it is required by law, or it could be a format which is developed by the management. So if it is a format developed by the management and CA has accepted the engagement, so it's unacceptable and he should not accept. But still, if he accepts the engagement, he will not mention that he has done the engagement in accordance with SA 810. It says if the applied criteria is not acceptable, but still if the CA accepts the engagement. Now don't write that you did the engagement as per SA 810. Right? Then again, appropriate reference to this fact has to be mentioned, and summary financial statements should clearly disclose their summarized nature, right? So you can't just write balance sheet. If it's a summarized balance sheet, can I just write balance sheet as a 31st March 25? No, it has to. So somebody might think this is the complete balance sheet. So for it to be clear that this is not complete, this is summary. Either you write the word abridged balance sheet, or you write the word condensed balance sheet, or you write the word summary balance sheet or summarized balance sheet, wherein it becomes clear that this is the summary. This is not the complete financial statement. So it has to adequately disclose their summarized nature. So what is the first condition for accepting the engagement? Is the acceptability of the applied criteria. Then what is the second condition? Agreement of the management that it understands its responsibility for preparation of summary financial statements in accordance with the applied criteria. So management, who is responsible for preparing summary as per applied criteria? Management. Then these are summary financial statements. These are prepared from the audited financial statements, complete. Now, to the users of the financial statements, you are giving them the summary. Okay, this is the summary. But if some user of the summary wants to refer to the audited financial statements, it says management, it is your responsibility to make the audited financial statements available without undue difficulty, unless law regulation says that they need not be made available. Right? So one responsibility of management to prepare summary as per the applied criteria. Second, to make the audited financial statements available without undue difficulty, unless law regulation says that they need not be made available, right? So summary clearly disclose from whom or where audited are available, are audited there on public record, and whether ready access is available to the audited financial statements. And then to include in the audit report. Now, whenever management is going to, beat the trumpet or beat the drum everywhere, summary financial statements also a CA give report. Summary also CA give report. It says the report should be attached. Any document that contains the summary financial statements and indicates that auditor has reported, it says the report should be attached. Right? So these three are the responsibilities of the management. What are the responsibilities? To prepare summary financial statements in accordance with the applied criteria. Then to make audited financial statements available without undue difficulty. And wherever you're going to say, our CA has given report on summary financial statements, the report should be attached to that document. Right? And what is the third one? Agree with the management, the form of opinion to be expressed. Right? So these are the three considerations while accepting the engagement. Are you able to follow, everyone? Are you getting an outline of the standard that we are discussing over here? Okay, right? So first one is the acceptance. Now coming to the procedure. Abhi tak 800, 805, what did we say? 800, what did we say? Comply with all essays. 805, adapt all essays. Now here, no comply, no adapt. Now here we discuss the procedure specifically of essay 810, and according to me, this is R raised to 50, right? Big possibility of a question on this one coming in your exam. Let's try to visualize. Everybody sit straight. Right, let's try to visualize that you are the same auditor who has done the audit of the audited financial statements, and now you have to issue a report on the summary financial statements, right? So management says, see a tick. These are our summary financial statements, give us a report. Obviously, this summary is prepared on the basis of the audited financial statements. What I have to do, give a report on summary. So now, first 2 points in this summary financial statements, I will check that whether these summary financial statements adequately disclose their summarized nature. Adequately disclose their summarized nature. So I go to the summary and I see whether it is written over there, summary balance sheet, summary profit and loss, summary cash flow statement. And second, summary financial statements, do they adequately disclose their applied criteria, right? So see what criteria management is used in the preparation of summary, is that given in the summary. Like how in financial statements, applicable financial reporting framework, accounting policies are given. Likewise, in summary financial statements, the applied criteria should be given. So what is procedure number 1 and 2? Whether summary financial statements adequately disclose their summarized nature, do they adequately disclose the applied criteria? Third one, check whether in the summary financial statements, the management has disclosed from whom or where are the very good. From whom or where are the audited financial statements available? Have they disclosed in summary? From whom or where? So if any user of summary wants to read the audited financial statements, have they given in summary from whom or where they are available? And if law regulation says they need not be made available, then which law regulation says so? Now, in the summary, they have written, okay, audited are available on the website of the company. So have I checked for point number 3? In the summary, has management disclosed from whom or where audited are available? So they've given over here that they are available on the website. So what I do, I click on that link, where they say they are available on the below mentioned link. I click on that link and then comes error 404. So nothing found. Right? So what is point number 4? Are audited financial statements really available where they are said to be made available? So they are saying they are available on the website. You actually go to the website of the company and check. Are they really available where they are said to be made available? Do you understand the difference in point number 3 and 4? What is 3? Whether they have mentioned in the summary where audited are available, whether they've disclosed. And then point number 4, you actually go and check, are they really available where they are set to be made available. Now coming to point number 5, which is the most important one. What is that? You compare the summary financial statements to check whether they are properly derived from the audited financial statements. So you compare, okay, summary financial statements, say over here it is shown as property, non-current assets, NCA as 10,000 crore. But in the detailed financial statements, it could be property, plant, equipment, and then intangible assets, all of that put together could be 10,000 crore. So you tally, compare the amounts in the summary financial statements with the amounts which are there in the audited financial statements. Then next you check whether summary financial statements have been prepared by the management in accordance with the applied criteria, that what they have written, okay, this is summary, that is why we have not given the breakup of our inventory. So, and then you go to summary and you see full breakup of inventory is given. So then have they complied with the applied criteria? No. Right? So they've written in the criteria, because it is summary, breakup of inventory will not be given, or it will be given. And then you check whatever they have said in the applied criteria, whether that has actually been followed while preparing the summary. And last point, it says, I understand what you're saying, this is summary. Obviously, it will not have all the details which are there in the audited financial statements. But in the process of summary, is any place over summary happened? Okay, are they at an appropriate level of aggregation? And you say, oh, this is summary. That is why a fraud of 1200 crore, you did not put it. So it says this is over summary. And this is not summary, this is over summary. So are they at an appropriate level of the aggregation? Okay, in the process of summary, have at any place you over summarized, is what they are trying to tell you to check over here. These are the 7 procedures which you need to follow when you have to give a report on the summary financial statements. What is this? Visualize. Summary financial statements and full audited financial statements. It is the same auditor. First point in summary, what you will check? Whether they adequately disclose their summarized nature. Wonderful. Whether they adequately disclose the applied criteria. Super. Whether they disclose from whom or where the audited are available. Are they really available where they are said to be made available? Then you compare with the summary audited financial statements. Are they properly derived? Then are they prepared as per the applied criteria? And are they at an appropriate level of the aggregation? Clear to everyone? Okay. And then you have to form your opinion. An opinion I already discussed with you. For fair presentation framework, you will say that it is a fair summary. And for compliance framework, you will say that it is consistent with the audited financial statements. Okay. Now, again, you need to listen from the perspective of the MCQ. What does it say? If the auditor's opinion on the audited financial statements is a qualified opinion, or it is an emphasis of matter or other matter, then what does it say? In that case, you will state that the audit report on the audited contains a modification. Second, copy paste the basis for modification paragraph. And second, consider the effect thereof on the summary financial statements. Right? So here you say true and fair, except for. So now here what you will say? Fair summary except for. Okay, it is a fair summary of the audited financial statements except for. You understand? So the effect thereof on the summary. And here if there is emphasis matter, other matter, you copy paste that in your summary financial statements ka report. This is point number 1. If the auditor's opinion on the audited financial statements is QO. QO is what? Reservation, qualification, exception, or it has an emphasis of matter or other matter. You state that the report contains a qualification, emphasis, other matter, copy paste that paragraph and give the effect thereof on the summary financial statements. Now point number 2. If the auditor's opinion on the audited financial statements is an adverse or a disclaimer, point number 1, same. State that the report contains a adverse or disclaimer. Second, copy paste the basis for adverse or disclaimer of opinion paragraph. And because the auditor's opinion on the audited financial statements is an adverse or a disclaimer, you say that it is inappropriate to express an opinion on the summary financial statements. That means it has to be a disclaimer. Why? Because here you're saying entire financial statements not a true and fair, and here you say it is a fair summary of financial statements which are not true and fair. You understand? Audited financial statements, you're saying adverse. Adverse means what are you saying? Not true and fair. And now in summary, you're saying it is a fair summary of the financial statements who khud hi are not true and fair, who themselves are not true and fair. No, it is not right. So what you say? It is inappropriate to express an opinion on the summary financial statements. Okay. And then one last point of SA 810. Okay, when you are issuing a report on the summary financial statements, now in your introductory paragraph, there will be 5 points. You remember in SA 700 also, introductory paragraph, there were 5 points. What were the 5 points? Stand. Right? Those were the 5 points over there. Now, in your audit report on summary financial statements, in the introductory paragraph, what are going to be the 5 points? One, it says you have to identify the summary financial statements, identify the audited financial statements, also mention about the audit report on the audited financial statements. Now say auditor gave a report on the audited financial statements on 25th April. Now he is giving a report on summary financial statements on 15th of May. So now subsequent events up to what date would have been considered by the auditor? 25th of April, the day on which he completed his audit. And now those audited financial statements ka summary is being prepared. So are the events between 25th April to 15th May being considered? Are the subsequent events between date of audit report of audited financial statements or an audit report of summary financial statements being considered? No, they do not reflect the effect of the events. Do not reflect the effect of the events between the date of audit report of audited financial statements and the date of audit report of the summary financial statements. And summary financial statements, do they contain all the detail which are there in audited financial statements? Summary financial statements, does it contain all the detail which are there in audited financial statements? No, then we would have not called it summary. So obviously reading summary financial statements is not a substitute for reading the audited financial statements. Reading summary is not a substitute for reading the audited financial statements. These are the 5 points you have to write in the introductory paragraph in case of SA 810. You understand? Normal audit report introductory paragraph. Stand. We have audited. You remember? We were engaged to audit and all of that. Here, what does it say? Summary financial statements, audited financial statements, auditors report on audited financial statements, subsequent events not covered after the date of audit report of summary financial statements, and reading summary is not a substitute for reading the audited financial statements of ABC Company Limited, whatever it is. Right, so everyone, do you get a aerial view or an helicopter view of SA 800? 805 and 810. In all the 3 standards, what you have to remember, first is meaning or the introductory part, and then the acceptance planning, performing, and the reporting. Okay, right. So that's our chapter number 8. Then now we come to chapter number 11, right, which is regarding the review of financial information, right? 10 also we'll come to it shortly. Right, so now, yes, today in the beginning, we discussed that there are these, right, there are these 4 types of engagement. We said, no, our standards are called as the engagement and quality control standards. And what are the engagements? Yes, audit, review, assurance engagement other than audit or review. So that's called as your other assurance engagement. And apart from assurance engagement, you could also be providing the related services. Okay. Now, audit and review. Audit and review. What is common about the two is that both are post-mortem activities. Why? Because both are performed on the historical financial information. Right? Audit and review, both are performed on the historical financial information. Okay. Right. So now, when CA has been appointed to do an audit of the financial statements, the CA will give a reasonable assurance that financial statements are free from material misstatement. But when that same CA is appointed to do a review of the financial statements, now he will give a limited assurance that the financial statements are free from material misstatement. Okay. Reasonable assurance is always given in the form of a positive assurance, and limited assurance is always given in the form of a negative assurance. So in an audit, we say financial statements give a true and fair view. In the review, we say nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view. So ultimately, what you're saying is true and fair, but only minus, minus, plus. Here I'm directly saying true and fair, audit. But review, what I say, nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view. That means what? They are true and fair. But limited assurance always has to be given in the form of a negative assurance. Limited assurance always has to be given in the form of a negative assurance. In an audit, we have mainly the 7 methods of obtaining the audit evidence, namely ICAIORR. In an audit, we do the test of control and the substantive procedures. Whereas in the review, mainly the procedures followed by the CA are inquiry and analytical procedures, right? So your main focus in case of review is on the inquiry and analytical procedures. So 100% audit is more in scope as compared to a review, and review is less in scope as compared to an audit. In an audit, after performing the audit, we obtain the sufficient appropriate audit evidence, whereas in a review, we obtain the sufficient appropriate evidence. There is nothing called as sufficient appropriate review evidence. It is just sufficient appropriate audit evidence. In an audit, after we finish our audit, we give the audit opinion, whereas in the review, after we finish the review, we give our review conclusion, right? We give our review conclusion. In an audit, we consider whether the financial statements, there is a risk of material misstatement, whereas in a review, we check whether it is likely to be materially misstated. Is there is a likelihood of material misstatement? Is there a potential of material misstatement? Is there a potential of material misstatement? Right. So now, when client has prepared their financial statements of 31st March 2020, example, and they say, CA, please check. CA, we prepared this 2020 ka financial statements post-mortem, history. Hello. So now they say, CA, please check. CA says, no problem. I can give you 2 options. See, one, I can either do an audit or I can do a review. If I do an audit, I shall give you a reasonable assurance. If I do a review, I will be able to give you only the limited assurance. If you want me to do audit, I will take 30 days. If you want me to do review, I will finish it in 10 days. Audit fee is going to be 50 lakh. Review fee is going to be 10 lakh. You tell me what you want to get done. You understand? Yes, audit and review. Now, where an audit is required, but client doesn't want to spend 50 lakh. That is why they say we'll get review done. It's not a substitute. And getting a review done is not a substitute for getting an audit done, where audit is required by the law. Many companies, what they do, listed entities mainly, they have to declare their quarterly result. So quarterly result, either they have to be audited or they have to be reviewed. What we popularly know it as the LR. What is LR? Limited review. And limited review. So now what does it say? these companies, what they do, June, September, December, they get the review done, quarterly review done, and later on at the end of the year in the month of March they get the audit done for the entire financial year. Or if the company is in a hurry to declare their result, okay, 30th June quarter got over and 5th July they want to declare their result. Now 5th July, 5 days audit not possible, or 4 days not possible. So then what they do, first give the review result, and then after 20 days, then on 20th July, later on the audit result can follow, audit report can follow. So sometimes, first they can do the LR and then later on follow it by audit, or they can only get an LR done, or they can only get the audit done, depending upon the requirement of law, depending on how much money the client wants to spend, and so. Okay, now for review we have two standards. We have SRE 2400 and SRE 2410. What is the title of 2400? Engagements to review the historical financial statements, right? Engagements to review the historical financial statements. And 2410, what is the title? Review of interim financial information performed by an independent auditor of the entity. Performed by an independent auditor of the entity. That means when the person doing the audit and the person doing the review are, when the person doing the audit and the person doing the review are different, then you need to follow 2400. So person who is doing the audit, PwC, review is being done by KPMG, then in that case KPMG has to follow SRE 2400, right? So person who is not the auditor of the entity is doing the review, and here the person who is the auditor of the entity, when he is only doing the review of June, September, December interim financial information, then that is called as the, right, of the interim financial information, then that is SRE 2410. Do you understand? So in the 2400, the CA who is doing the review, obviously person doing audit is auditor, person doing review is not reviewer, person doing review is called as practitioner. Right? And 2410, it is the auditor only who is doing the review. It is the auditor only who is doing the review. So here to this fellow, can we refer to him as the auditor? Yes, we can refer to him as the auditor. 2400 is an old standard which has been revised, whereas 2410 is relatively, it's also pretty old now, but relatively it is a new standard which has been issued by the ICAI. You understand? So in the exams, what is your checkpoint? If they say practitioner is appointed to do a review, then you have to go to 2400. You come to know that the auditor of the entity is doing review of interim financial information, then that fellow has to follow SRE 2410. Right? 2410. Are you understanding that? Okay. It's a review engagement. Is the CA required to comply with ERII? Ethical requirements including independence, both in case of 2400 also and 2410 also. Yes, in both cases you have to comply with the ERII. Do you need to comply with SQC1 in both the cases? Yes, because SQC is applicable to the entire firm, whether doing audit, review, other assurance, or the related services engagement. Are you able to follow this? So very important 2 points of distinguish that we need to know over here is, one, what is the difference between an audit and a review, and second, what is the difference between the SRE 2400 and the 2410. Do you know the title of 2400? Engagements to review the historical financial statements, and 2410, review of interim financial information, June, September, December, performed by an independent auditor of the entity. You understand that? Okay. And what are the procedures which are mainly performed in review? Which are the procedures which are mainly used by the CA in case of review? Inquiry and analytical procedure. So generally, like maximum, what procedures which I will try to perform in case of review is inquiry analytical procedure. But you know, like I am doing some review of the financial information, inquiry analytical, and I find out that one contract seems to be very significant. So that is why I end up reading the contract. So now actually when I read the contract means what has happened? I have done inspection. In a review, you're mainly supposed to do only inquiry analytical, but on exception basis, somewhere I had to do the inspection, or somewhere I had to get a confirmation from a third party on exception basis. Does that change my objective of review if I do little bit inspection here and there? They say out, now you did inspection, now it has become audit. No. Even though little bit here and there I do some inspection, some observation, you can't go with your eyes closed, no, because you say, no, I have to do only inquiry analytical, I can't observe anything. So little, don't kill the person. No, you said now only inquiry analytical, now why you did observation, why you calculated. No, don't take the life, of the CA. So it says, even though little bit he happens to use some other audit procedure, does that change my objective of a review engagement? No, still what is my objective? To give the limited assurance, to give the review conclusion, even though little bit here and there I happen to perform some other audit procedure also. Now, how many candidates were standing for the election? 7. ICAIORR. But in review, which two won? Inquiry and analytical procedure. So it says when you're doing review, no inspection, confirmation, observation, recalculation, reperformance. So who won it? Analytical procedures and the inquiry. So the question is, why inquiry and analytical are important? Okay, why they say when you're doing a review, you should do inquiry analytical procedure. So one, what inquiry you will do. So we have hundreds of matters on which we do the inquiry. Then why you do analytical procedure, how you do analytical procedure, and then why you're doing inquiry analytical only. Right? So these are two important questions that we have over there. Okay, in inquiry, what inquiry do you do? When you do analytical, what analytical do you do? And why are you doing inquiry analytical only? Okay, and what is the title of 2410? Please listen to me. Review of interim financial information performed by an independent auditor of the entity. That means 31st March 23, I would have already done the audit of Geo Limited. Example. No, 30th June 24, 30th June 23, sorry. Right, 30th June 23, I am doing the review of the interim financial information. Already have I done their audit up to last year? Now for first quarter, I'm doing the review. So do I already have understanding of the entity and its environment? Because I've already done the audit. Now I'm doing the review of the interim financial information. So do I already have the understanding of the entity and its environment? Yes, but now what I need to do, I only need to update my understanding of the entity and its environment, right? So this is again $1 million question. Okay, what are the matters which you need to consider when you're updating your understanding of the entity and its environment when you come to do the review of the interim financial information? Because when you did the audit, you've already understood. Now you're coming for the review. So can you use that understanding of yours? Yes, but you only need to update. You understand the variety of questions that we are asking? Yes, which are being asked over here? Okay. And obviously in my review report, what is one important sentence which I will write? Okay, audit is not being performed, audit opinion is not being expressed. And audit is not being performed, audit opinion is not being expressed. It is a review which is being done. And you have to specifically mention that it is a review which is being conducted. Okay. Right. So with all that in the mind, let us quickly go through our discussion for the SRE 2400 and the SRE 2410, right? Then we shall also come to the compilation engagement also. See, I told you for 810, important question, nature of procedures to be performed. Then also the acceptance of the engagement and then the modifications to the opinion, right? That's the question bank for SA 810. Okay. right? Then you have the related services, and then after that you have the review, right? So review of financial information. What did we say? Review is a limited assurance, lower level of assurance than an audit. And obviously, mainly the procedures followed are inquiry and analytical, and 2400, 2410, and SQC is always applicable. Okay, right? So what does it say? Practitioner's responsibility. Why practitioner? Because he is not the auditor of the entity, the fellow who is doing the review. So to enhance the degree of the confidence of the intended users, what type of an assurance? Limited assurance, mainly inquiry and analytical procedures. And again, what does it say? If they are likely to be materially misstated, may be materially misstated, he may perform the additional procedures, right? So we'll come to those additional procedures also. What is 2400? When he is not the auditor of the entity. What are the objectives of review? Limited assurance, inquiry, analytical, and then to give a report. Right? Inquiry, analytical, and then to give the report. Do you need to comply with ethical requirement? Yes. Do you need to maintain independence? Yes. Then acceptance continuance. Where did we see this today? SQC 1. In SQC 1, LEAHEM. What was A? Acceptance continuance of client relationship, right? So there is a reason why I took those standards before coming to these 10 standards which I had to discuss with you, right? So acceptance continuance of the client relationship and the review engagement. Do you remember the points of yes, SQC 1 for acceptance continuance of the client relationship? Yes, number 1, macronil. You remember Mr. Macronil, right? You have to check the integrity of the client. Second, you have to check whether you have the CCTR, the competence, capability, time and resources to perform the engagement. And third, whether you'll be able to comply with the ethical requirements, including the independence. And regarding all of this, you have to obtain the information. Now we are talking about the acceptance continuance in SRE 2400, right? 2400. Now here, acceptance continuance, what are they saying? Okay, is there a rational purpose, okay, why they are getting a review done, right? So it says practitioner will not accept a review engagement if he is not satisfied that there is a rational purpose, like actually they need to get an audit done, but because audit is expensive, that is why they are getting a review done. So there is no rational purpose, and a practitioner is not satisfied that there is a rational purpose, and he says that I am not satisfied that review would be appropriate, right? That you need to go for an audit done itself, right? So one, what does it say? When the practitioner is not satisfied regarding what? Yes, the purpose why they are getting the review done, and second, whether review is appropriate or no. Next, what does the practitioner say? He says, I think I will not be able to comply with the ERII. Again, then in that case, no accepting, continuing the engagement. Then he says, I think all the information which will be required for the review may not be available. If it may not be available, that means there could be a limitation on the scope. And then he thinks that he has concerns regarding the integrity of the client, right? So these are the considerations for accepting, continuing the review engagement. What does it say? When you should not accept the review engagement if you are not satisfied that there is a rational purpose or review is appropriate. Second, you say, I think I can't comply with the ERII, or I think that all the information may not be available. That means there could be a limitation on scope, or I have concerns regarding the integrity of the client, right? So information may not be available, or concerns regarding the integrity of the client, right? So that's one new question over there regarding the acceptance continuance. Now what happened? You read acceptance continuance and you write down the points of SQC1, and it's a question from review. You will not get the marks in the exam. You understand? No, that's why I've made the comparative over here. Okay, acceptance in SQC1, these are the 3 points. And now in SRE 2400, rational purpose and all of that. Okay, then after that, next set of points, after the ethical requirements and quality control, preconditions, right? So again, precondition, what is the giant precondition? The acceptability of the AFRF, right? So whether, you remember preconditions, everyone, 1 plus 5. right? So acceptability of the AFRF. After one is fulfilled, what are the five? Preparation of financial statement management, your responsibility. Internal control management, your responsibility. To provide auditor with all, no, not auditor, practitioner, with all information, additional information, and unrestricted access. Whose responsibility? Management, your responsibility. Right? So is this absolutely same like 210? Yes, the 1 plus 5, the preconditions for the review engagement. And if you're not satisfied, then what does it say? Not to accept the engagement. And later on, if you think that it is not appropriate, then what do? Check how the matter is resolved, whether you should continue with the engagement, and if so, communicate the matter in the practitioner's report. Right? So first you thought of whether you should accept. Then after that, you issued the engagement letter. Yes, after that, you check whether the preconditions for an audit are present. Once you know that the preconditions are present, now you will issue the engagement letter. You will revise it as required. When there is any change, you will check whether there is an RJ. I told you what is RJ? Reasonable justification to do so. And then after that, now you come to the performing. Right, so this was all your A part. What did I tell you? Acceptance, planning, performing, and reporting. So right now in acceptance, we discussed 3 points. Acceptance, continuance of client, then preconditions, then engagement letter. Now we come to the planning, performing. In the planning, performing, we have 5 points over there. What are the 5 points? Determine materiality, then understand the entity and the AFRF, then mainly perform the inquiry analytical, then perform procedures to address the specific circumstances and perform the other procedures, right? So one by one we discuss this. So even in case of a review, do you need to determine materiality? Yes. Could you revise the materiality as the work progresses? Yes. Even in case of a review, is understanding of entity required? Right? Understanding, knowledge of the client's business required? Yes. And now what you do, you design and perform your procedure in order to obtain the SAE, sufficient appropriate evidence. And for that, mainly the procedures performed are inquiry analytical. But sometimes can it so happen that you happen to read a contract? But if you perform these other procedure, does that alter your objective of limited assurance? No. Right? You may also review the accounting records. You understand, no, what I say? Okay, mainly we are supposed to do inquiry analytical, but little bit I happen to read a contract, I happen to perform some other procedure. Does that change my objective of review engagement? No, that does not alter the objective. Okay, and now it says what are the procedures you perform is inquiry and analytical. So one, what does it say? What do you inquire about? So now look at review. It's like a limited version of an audit. And a review is like a limited version of an audit, because now you're inquiring regarding the accounting estimates, then about the related parties, then the complex unusual transaction, then the actual suspected or the alleged fraud, then the events occurring between the date of financial statements and practitioner's report, then going concern events or conditions, then significant doubt, and the next one, material commitment, contractual obligation or contingencies, and then the disclosures and material non-monetary transaction. Right? So first point, it says you have to inquire about these 8 points. And so it's like a mini version of audit. Subsequent events, related party, going concern, fraud, non-compliance, everything covered in inquiry over here. Right, then second inquiry, what do? You also inquire about the non-financial data. Then it says sometimes you could also inquire about the action taken at the meetings. This is such a wonderful point. Okay, if I'm doing an audit, I inspect the minutes of the meeting. But here I don't use inspection mainly. So what I do, I inquire about the actions taken at the meetings of the owners and TCWG. I inquire about the communication the entity has received from the regulatory agency, and I apply the matters which have arisen in the course of applying the other procedure. Right? So first inquiry is regarding the 8 matters. Then after those 8 matters, next inquiry could be towards the non-financial data. Then third inquiry could be regarding the actions taken at the meetings, then also the communication from the regulatory agencies, and also the results of applying the other procedures. Okay, then if based on these inquiries I come to know about any inconsistency, it says now you need to do the further inquiries. Okay, so for that one inquiry, they can ask a 4-mark question in your exam. Right, so 8 inquiries, then non-financial data, then meeting ka inquiry, and then the further inquiries. Then it says in addition to inquiry, what is the second procedure? Analytical, to check whether is analytical procedures, the data used for analytical, is it adequate? And now, I told you now why out of the 7, these 2 won the election. And okay, why for review they selected the inquiry and analytical procedure? Because if I have to come to know, okay, why management is you taking the estimated useful life of the asset as 7 years and not taking it as 4 years. So obviously that depends upon the management intent, and the best way to come to know about the intent of anybody is by doing the inquiry. Right, the best way to come to know about the intent. So if I want to come to know about the intent of the management, what does it say? What is the important tool required for that is the inquiry. If you're having that questioning mind, obviously questioning mind also requires you to do the inquiry. Right, and then by doing this inquiry, so one, you're doing inquiry of the management's intent. Then by doing this inquiry, you're trying to understand the entity and its environment and identify the LMM. In an audit, we identify RMM. Here we identify likelihood of the material misstatement. Right? Likelihood of the material misstatement. Okay. Right? And then why analytical? So why inquiry? For management's intent and the LMM. And for these 2. And then why analytical? It says to identify again whether there is any LMM, likelihood of material misstatement, any inconsistencies, any corroborative supporting evidence, and the additional procedures. Right, so 2 questions over here, why inquiry and why analytical. Before this, what were the 2 questions? What inquiry, what analytical. Now question is why inquiry, why analytical procedures. Then it says though you're doing a review, it's a mini version of an audit. So will you consider related parties? Yes. Will you check for fraud, non-compliance, going concern? Yes. Even in case of a review, you check for all of this. And in a review also, will you have to use the work performed by others? Yes, you will have to use the work performed by others. And now again, they make your life interesting. What does it say? While doing the review, the CA, the practitioner, may come across a situation where it could be an MMM. What is an MMM? Where the financial statements may be materially misstated. So practitioner has done inquiry, he has done analytical procedures, and after doing that, what he has reached to, I think there may be a material misstatement. It says if you reach at a point where you think that there may be a material misstatement, you have to perform the additional procedures till the time you reach not likely to be materially misstated or materially misstated, or third is still likely to be materially misstated. So it says if you come across a situation where they may be materially misstated, it says do additional procedure. By doing the additional procedure, you may reach to 1, 2 or 3. What is 1? Not likely to be material. So you conclude, okay, no, I thought, but it's not. And I thought maybe, but I say no. Or I say, see, I told you only, and there is material misstatement. So if you reach 1 and 2, you can conclude. But if you reach 3, what is 3? Still you are dilemma, okay, likely to be materially misstated. It says keep performing additional procedures, keep doing the additional checking till the time you don't reach 1 or 2. So if you are at MMM, you do additional checking. What could be the outcome of that? 1, 2, 3. If you reach 1 and 2, finish. But if you reach 3, you still continue performing additional till the time you don't reach 1 or 2. And if you're not able to reach to 1 or 2, then again it will be a limitation on scope. You're not able to form an opinion. Right? So what does it say? You could be in a situation where you are at MMM. What is MMM? May be materially misstated. And what you want to reach to is NLMM or MM. That is materially misstated. For that, what you do? Additional procedure, additional inquiry, analytical, other types of the procedure. After doing these additional procedures, you may either reach to NLMM or MM, or you might be still hanging at LMM, that is likely to be materially misstated. If you're still hanging at LMMM, you still continue doing the additional procedures till the time you don't reach to A or B. And if you're not able to reach to A or B, then that's a scope limitation. Right? That's a scope limitation. Even in case of a review, is the practitioner required to take a written representation from the management? Yes, and that is where the question comes in the exam. Contents of written representation in case of review engagement. Right, so again it says that management has fulfilled its responsibility, all transaction, public statements, and then the other representations, right, regarding the 8 points of the inquiry. And then evaluating the evidence. So what you have to check whether sufficient appropriate evidence has been obtained from the review engagement. And then finally forming your opinion. What did I say? Will you call it unmodified opinion? No, you will call it unmodified conclusion. Will you call it qualified opinion? No, you'll call it qualified conclusion. Basis for qualified conclusion. So same 705, but instead of saying opinion, now here you will say, use the word conclusion. Okay, right. So then again the effect, practitioner's report. Right, a review. Then you say review is less in scope as compared to an audit. Auditor, the practitioner does not express an audit opinion on the financial statements, and then the signature, place and date. Okay, right, then what documentation? Even these are the questions which are there in the question bank. Okay, what is the documentation to be kept in case of the review engagement? Okay, right, and then distinguish. Now look at them. At the end of the standard, in the study material, they've given the distinguish between audit and review. And okay, what are the points of distinction? So again, that's an R raised to 10. We made so many points of distinction between the audit and the review. And now we come to review of interim financial information performed by the independent auditor of the entity. So here that fellow who is doing the review, we can call him as the auditor. Why? Because it is the auditor who is doing the review of the interim financial information. Okay, so it says inquiry, analytical and other review procedures, right? Again, not designed to obtain a reasonable assurance. Is the engagement letter required? Yes. Understanding of entity, is it required for review? Yes, but here you identify the potential material misstatement. And what are your responses? Inquiry, analytical and the other review procedures. And do you already have knowledge of the entity and its environment? Yes, but now what you have to do, you have to update. This is R raised to 50. No surprise if I see a question on this one coming in the exam. It's just a matter of when. Till the time it doesn't come, every marathon batch I'll keep on saying R raised to 50. So you don't worry about me. You understand? No, but just that, it's just a matter of when it comes in the time machine. But it is certainly going to be seen because it's there in the study material of ICAI. Okay, right. So how do you, what is the question? How do you update? Why update? Because you already have the knowledge, because you've done the audit. Now you're doing the first quarter review. So you have to update your understanding. So now what does it say? Read the documentation to the extent necessary of the preceding year audit and the review. Right? So one, you read your last year audit file. Is it right? Then it says consider any significant risk, including the risk of MOC. Did I teach you this term today? Management override of control, recording fictitious journal entry and a bogus journal entry. Right? So one, you read the documentation. Second, you consider the significant risk. Third, you read the most recent annual and comparable prior period information. So one, you read the documentation. Second, you read the information, the comparable information. Then it says you consider the materiality with reference to the AFRF. Then consider the nature of any corrected material misstatement and the uncorrected immaterial misstatement in the prior year. That means last year, whatever misstatements you had identified and told it to the management and which were corrected by the management and not corrected. Which auditing standard? Which auditing standard? Corrected and uncorrected misstatements. SA 450. Evaluation of misstatements identified during the audit. Then any material weakness in internal control. That is SA 265. 5. Right? The results of audit procedures with respect to the current year. Then the results of the internal audit. Then management's assessment of the risk. Right? That interim may be materially misstated. Then inquiry regarding change in the business activity. Inquiry regarding the change in the internal control. So one, you look into the results of audit procedures, then the results of internal audit, then change in business activity, change in internal control. Then you also look into the management's assessment of the risk, right? And then after that, inquiry of the management of the process by which the interim information is being prepared, right? So 2 points of result. What are the 2 points of result? Results of audit procedure, results of the internal audit. Then after the results, what are 2 more points over there? Change in business activities and change in control. Then you also inquire into management's assessment of risk and the process by which management has prepared the interim financial information. Then what you also do, you read the documentation, you read the comparable information. Then what you consider the significant risk, consider the materiality, and consider the corrected misstatements, and consider the material weaknesses. Right? So 2 points over there. What are the 2 points? Read the documentation, read the prior period information, then consider the significant risk, consider the materiality, then consider the material misstatement and the material weakness, then consider the results of the audit procedures and the internal audit, then change in business activity and change in the internal control, and management's assessment and management's process. Okay, right. Then mainly what are the procedures you follow over here is again the inquiry, analytical, and the other review procedures, right? So inquiry, analytical, and ordinarily what are the procedures? Reading the minutes of the meeting. Now ideally you're not supposed to read because mainly inquiry, analytical, but what does it say? You may read the minutes of the meeting. Consider the effect of matters that give rise to the modification. So that is your essay 705, right? Read the minutes of the meeting, then communicate where appropriate with the other auditors. So that is your essay 600, using the work of another auditor. And now comes to your inquiry. 2400, we had 8 inquiries, then non-financial data inquiry, then meeting ka inquiry, and further inquiry. Now your inquiry, different points. That is how your life has to be specific. Okay, 2400 inquiry, different. 2410 inquiry, they say AFRF, change in accounting principle, new transaction, uncorrected misstatement, unusual complex situation, right? Significant assumptions, related party, commitment, contingent liability, debt covenants, then the matters which arose, and last several days. This is one MCQ they made. And okay, inquiries when you make of last several days and first several days of the next interim period to check whether the cutoff is proper. And cut-off procedures, then knowledge of fraud, allegations of fraud, any non-compliance, and so. Right? So these are the inquiries under SRE 2410. Right? This is inquiry. Then apply analytical, read the interim financial information. And now, now for the 30th June quarter, I am doing the review. Already 31st March 23, I have done the audit. Now for 30th June 23, 30th September 23, and then for 31st December 23, I have to do the review. And then come 31st March 24, I'll again have to do the audit. So when I'm doing the review only, can I do some extra checking so that my audit purpose is also solved? Yes, because it is the auditor only who is doing the review of the interim financial information performed by the entity. So what does it say? The reviewer auditor may perform many of the review procedures before or simultaneously. Right? So audit and review procedures, it says you can perform them concurrently, you can perform them simultaneously. Now generally in a review, do you send an inquiry letter? Generally in a review, will you send inquiry letter? No. Review generally it is only inquiry and analytical procedures. If I send an inquiry letter, then that is the confirmation. So normally should I send an inquiry letter? No. What does it say? It is therefore ordinarily not necessary to send an inquiry letter. But when will you consider it that, no, I think that though it is review, I should get a confirmation, when you think that the information could be materially misstated or it is not prepared in accordance with the AFRF. So by default, our preference is to inquiry analytical, but if required, we also go for the other procedures. Okay, right? Then interim financial information, we also check for going concern, subsequent events, and all of that. Again, obtain the written representations, other information. So this is nothing but your 720. Right? So just as in audit, you have the other information, in review, you have the accompanying information. Then also you communicate the non-compliance, and finally coming to the contents of the report. But what is your main discussion over here? It is regarding the inquiry analytical, how you update your understanding of the entity and its environment, right? And second question is what inquiry and what analytical procedures, right? So very interesting, test your understanding questions again given over here. Okay, right? So this is on priority, right? So all these questions, if you look into this book, one, you see all the questions as per the study material of the ICAI, then the integrated case scenario again as per the study material, and then the test your knowledge. It has the questions as per the institute study material also, plus the questions which I told you which were there up to the May 19 exams. Even those have been incorporated over here. Okay, right. So that is SRE 2400 and 2410. So do you understand 800? Special purpose framework. 805, single financial statement, specific element, account or item. 810, summary financial statements. 2400, review of historical financial statements. And 2410, interim financial information performed by an independent auditor of the entity. Okay. Now, if client has prepared financial statements of 31st March 20, then that is historical financial information. What I can do, either I can do audit or I can do the review. Both are post-mortem activities, only level difference in the level of the assurance. Now, client has prepared financial statements of 31st March 2035. Okay, so now what client has prepared is the prospective financial information. Can I audit? Can I audit? No, because audit is post-mortem. Can I review? No, because both are for historical. So now what I will do, I will examine. Right, so here the report is auditor's report. Here the report is practitioner's report. And now the report is going to be the examination report. In an audit, how does my report start? We have audited. In review, how will my report start? We have reviewed. In this SAE, how my report will start? We have examined. In an audit, what type of assurance is given? Reasonable assurance, given in the form of a positive assurance. In a review, limited assurance, given in the form of a negative assurance. In an examination engagement, again it is the moderate level of assurance, given in the form of a negative assurance. Right? Moderate level of assurance given in the form of a negative assurance. Okay. The moment I talk about the word summary financial statements, what is the next word coming to your mind? Term coming to your mind has to be the applied criteria. The criteria applied by the management. SA 810. Now, the moment I talk about the word prospective financial information, the next word coming to your mind has to be the assumptions. Because what if management has to prepare prospective financial information? What is required for that? They have to make the assumptions. Okay. Now, these assumptions which the management is going to make for the preparation of the prospective financial information, they could either be the best estimate assumptions or they could be the hypothetical assumptions. Right? Best estimate assumptions or the hypothetical assumptions. Best estimate. today, up to 31st March 20, the sales price of the company's product is 200. Next year onwards, they are going to make it 220. So it is an action which management is going to take, or a condition which management expects to exist. Okay, right now the purchase price of raw material is 300. Next year it will increase to 350. So what is that? That's a best estimate assumption. Action, what is within their control? Sales price. They will take that action. And what is not within their control? That is a purchase price that they expect to exist. Right. And if prospective financial information, it's hypothetical assumption. Hypothetical assumption means it is what would happen if. And it's the what if scenario. What does it mean? Okay, you are going to a bank and telling bank, please give us a loan of 1,000 crore. Bank says, you first go and prepare your prospective financial information and get it to us. And now when I prepare this prospective for submitting to the bank, obviously what hypothetical assumption will I make? Okay, if we get the bank loan of 1,000 crore. Right, so if we get the loan of the 1,000 crore, so obviously hypothetical assumption is what would happen if. Right, so as an auditor, if here you call the CA as the auditor only, as an auditor, if I have to examine the prospective financial information, I have to check the assumptions, and assumptions could be best estimate or hypothetical. Okay, if prospective is prepared based on best estimate assumptions, it is called as the forecast. And if prospectus is prepared on a combination of best estimate and hypothetical assumptions, then it is called as a projections. Many companies, they go for a combination of a forecast and a projection. They say 1 year forecast plus 5 year projection. 1 year forecast and a 5 year projection, right? Because so what you understand, forecast is short term, whereas projection could be long term. Okay, so now obviously as a CA, if I have to check the prospective financial information, what I need to check is the assumption. So for best estimate assumptions, I need to check, are they reasonable? So if they say next year the sales price will increase from 200 to 220, I have to check whether this 220, is it reasonable? Okay, and now hypothetical cannot be reasonable, because if I get a loan of 1,000 crore, it's not reasonable. So hypothetical has to be consistent with the purpose of the information. It has to be consistent. Why you're preparing the prospective? To get a loan of 1,000 crore. So should you make a hypothetical assumption? If we get a loan of 1,000 crore, yes. What you're saying, okay, I want a loan of 1,000 crore. For that, I am preparing prospective. And in the prospective, what hypothetical assumption I have made? Next year, if we acquire Infosys. They say, like, it's not even consistent with the purpose of the information. You understand, you're writing your exams. What hypothetical assumption you should make? If I clear CA exams in the upcoming attempt, you say, if I become an aeronautical engineer. Now, how by writing CA exam you can become aeronautical engineer? Not possible. Right? So it has to be consistent. So when I check prospective, I have to check the assumptions. For best estimate, I need to check, are they reasonable? For hypothetical, I need to check, are they consistent? And second, what I have told in the best estimate assumptions, ke sales price will increase from 200 to 220, or if I get a loan of 1,000 crore. And now when I prepared my prospective, I made the assumption that next year if the sales price increase to 250, or if I get the loan of 1,500 crore. So now, what is happening? My prospective financial information, has it been properly prepared based on the assumption? No. Is it properly prepared based on the assumption? No. My assumption is 220,000 crore. What I have made over here, 250, 1,500 crore. Right? So what is the objective? One, to check whether the assumptions are reasonable for best estimate. Are they consistent for hypothetical? And second, to check whether the prospective financial information is properly prepared based on the assumptions. Right? Whether it is properly prepared based on the assumptions. Right? So say company says that 31st March 2035, 31st March 35, the revenue of the company will be 1800 crore. Example. And can CA say 100% guarantee that this will happen in 2035? Can CA give a report? Absolute assurance, 100% guarantee that this will happen in 2035? No. CA, you will be out under 312. What is 312? Clause 3 of part 1 of the second schedule. If he permits his name, CA is allowing, write my name, no problem. Permits his name to be used in connection with estimate of earning contingent upon future transaction. What do you mean by estimate of earning contingent upon future transaction? It is prospective financial information which is based on assumption. So what is 312? If he permits, he says, use my name, in connection with estimate of earnings contingent upon future transaction in a manner which may lead to the belief that the CA is vouching for the accuracy of the forecast. So CA, if you vouch for accuracy of forecast, out. You are guilty of professional misconduct under 312. But does that mean that CA cannot put his name along with a forecast? He can. What does it say? You cannot give 100% guarantee, but subject to these 4 conditions, you can associate with a forecast. What are the 4 conditions? Sources of information, basis of forecast, major assumption should be disclosed, and he should not vouch for the accuracy of the forecast. If these 4 conditions are fulfilled, then CA, can you permit to use your name along with a forecast? Yes. But if you say 100% this will happen, it says out. You are guilty of professional misconduct under 312. What is clause 312? Clause 3, part 1, second schedule. And vouches for the accuracy of the forecast. You understand that? And for best estimate assumptions, what you have to check, are they reasonable? For hypothetical assumptions, what you have to check, are they consistent? And then what you have to check, whether prospective financial information, is it properly prepared based on the assumptions, right? Whether prospective, is it properly prepared based on the assumptions, right? So prospective financial information, what is a forecast? If it is based on best estimate assumption. What is a projection? If it is based on a combination of best estimate and hypothetical assumptions. As an auditor, you have to do your examination procedure. So audit procedure, review procedure, now you have the examination procedures, and this applies to the prospective information and not descriptive narration given of the future and a vision, mission and all of that. It says applies to the prospective financial information given in numerics and not in general or narrative term. Are they calling the person doing the examination examiner? No, they say you continue to call him as the auditor. It is future oriented, speculative in nature. That is why, again, what did we say? What is the assurance? Moderate assurance, which is again given in the form of a negative assurance. Nothing has come to our attention that causes us to believe that the assumptions are not reasonable. That means what? That the assumptions are reasonable. Okay. Whose responsibility to prepare the prospective financial information? Management's responsibility. CA, what if you vouch for accuracy of forecast? Out under 312. But does that mean you cannot associate your name with a forecast? No, you can. Subject to these 4 conditions. Okay. Right. What is the duty of the CA who is examining the prospective financial information? Point number 1, best estimate assumptions are not unreasonable. That means they are reasonable. Hypothetical, are they consistent? Second, whether prospective is properly prepared based on the assumption. Then what did I tell you? In financial statements, accounting policy should be disclosed. In summary financial statements, the applied criteria should be disclosed. In the prospective financial information, the assumptions should be disclosed. I hope you understand this. Right? So in the prospective financial information, the assumption should be disclosed, clearly distinguishing whether it is a best estimate assumption or a hypothetical assumption, and obviously the prospective has to be consistent with the historical. So in historical, you've been following FIFO. So in the prospective also, you need to follow FIFO. And if you change your accounting policy, that has to be disclosed. Right? So duties of the member, again, a candidate for retail question. And okay, best estimate assumptions reasonable, hypothetical consistent, properly prepared, assumptions have been disclosed and on a consistent basis with the historical financial statements. Again, it is future oriented, speculative in nature. Then the considerations while accepting the engagement. So again, each standard what we have to discuss: acceptance, planning, performing, and reporting. So now acceptance. So you ask client, oh, you're preparing prospective, for what purpose are you preparing, till what period are you preparing? So they say we are tired of preparing prospective every year, so 31st March 2100. One time only we are preparing the future plan, and the government also does not plan beyond 5 years, but they say 31st March 2100. What assumption you are making? They say next year if we acquire Infosys, only one assumption. Only one assumption, only one date. And they say, CSA, life is easy. You accept this engagement. CSA is buy. Right? Why? Because look at the period covered. Right? Look at the intended use of the information. Look at the nature of the assumption, the elements to be included in the information. And again, whether the information is for general or limited distribution. Right? So what are the factors while accepting the engagement? The PINE. Right? Or you will be fined. Right? So what is the PINE? The period covered. Then after that, the information, right? The intended use of the information. Then the nature of the assumption and the elements to be included in the information. And if you think that these assumptions are clearly unrealistic, and next year if we acquire Infosys, you say, what are you talking about? And it's clearly unrealistic. Then what does it say? CA don't accept the engagement. And if you've already accepted, then you need to withdraw. So not accept, and if you've accepted, then withdraw, right? So that's again a candidate for the question. Right? Acceptance. Then after the acceptance, now here we have the examination procedures. What I have to do? I have to give a report on the prospective financial information. Now, when I have to do an audit, is KOC required? Audit, knowledge of client's business. Okay. When I have to do a review, is KOC required? Yes. Now I have to do examination. Is now also KOC required? Yes. It says you have to obtain the knowledge of the client's business. Right? You have to obtain the knowledge of the client's business. Now, see, preparing historical financial information is like a routine affair. Every quarter, every year they prepare. But prospective might be more creative work. So you have to look into the management's competence who is preparing the prospective. And again, for engagement team also, doing examination is more creative work. So even engagement team's experience. So client's competence and also engagement team experience. Knowledge of the business, also stability of the business. Then to what extent there is a chance of likelihood of the material misstatement, and how much is the prospective affected by the management's judgment. Okay, next year sales price will increase from 200 to 220. It's a judgment of the management, right? So what is point number 1? Knowledge of the client's business, the stability of the entity's business, then the competence of the management, competence of the engagement team, likelihood of material misstatement, then how much is it affected by the management's judgment. And the most important examination procedure is the sources of information. How did you make this assumption of 220? How you made this assumption of 20%? The sources of information considered by the management. Right, to support the assumption. Right, so that's the examination procedures. Right, so question number 1, acceptance. Question number 2, examination procedures. Now we come to the reporting. In the reporting, what does it say? Presentation disclosure. Again, a question which is there in the question bank. Right, so when I was reading the summary financial statements today, what did I see in summary? Point number 1 and 2. Nature of procedure. What was point number 1? Summary. Do they adequately disclose their summarized nature? Do they adequately disclose the applied criteria? Whether it is given from whom or where? audited are available. Are they really available? Where they are set to be made available. Similarly, now if you happen to read this prospective financial information, what does it say? One, this information should be informative and not misleading. Second, what does it say? All accounting policy should be disclosed. Any change in accounting policy should be disclosed, and the assumption should be disclosed, clearly distinguishing whether it's a best estimate or a hypothetical assumption. So what is point number one? The information should be given in the manner that it is informative and not misleading. Second, what should be given in this information? Accounting policy. Then change in accounting policy. Then the assumptions, clearly distinguishing whether it's a best estimate or a hypothetical assumption. Then, on which date did you prepare this prospective financial information? You understand? No. Say somebody is giving you the prospective financial information of 31st March 35 and 2035. So you say, oh, it's future, prospective. But it was prepared in 2005. It is prospective, but it was prepared in 2005. So the date on which it has been prepared. And so it should be prepared in 2025 or 24, not like in 2005. Again, it will be misleading. So it says the date on which the prospective has been prepared. And now, sometimes a prospective can be given that next year's sales price will be from 200 to 220, example. Or they can say, okay, this year the revenue of the company is 100 crore. Next year, it will be between 110 to 120 crore. So here now they are giving a range rather than giving a point estimate. So rather, see, if they say next year revenue will be 115 crore, then that's a point estimate. But if they say it will be between 110 to 120 crore, that means now they are giving a range. So how did they establish the points in a range? Even that is required to be given. The basis of establishing the points in a range. What are these 7 points which you see? First question is acceptance. In acceptance, kya tha? Pine. You remember pine? The period, then after the period you had the intended use of the information, then the nature of assumptions, the elements to be included, right? That was the acceptance. Then after that you had the examination procedures and knowledge of the business, stability of the client's business, then management's competence, the engagement team experience, then the likelihood of material misstatement, how much is it affected by the management judgment, and also most important one is the sources of information underlying the assumption. Next you have the presentation and the disclosure. What is point number 1? It should be disclosed in such a manner that it is informative and not misleading. Then point number 2, 3, 4. Accounting policy should be disclosed. Change in accounting policy should be disclosed. Assumption should be disclosed. For next one, the date on which this prospective has been prepared should be disclosed. And the basis of establishing the points in a range, even that should be disclosed. Okay. And then we come to the contents of the report, starting with title, addressee, identification of the information. It has been performed in accordance with, the examination has been done in accordance with SAE 3400, management's responsibility, auditors, right? Examination procedures to check the evidence supporting the assumptions. Then your negative assurance, right? Your negative assurance. Then the caveat. What is caveat? A warning. Okay, whatever is told over here is future oriented. It may or may not happen, and the actual results may deviate from the expectation significantly. Okay, we said sales will be 110 next year, but it might become 190 also, it might become 70 also. Right? So warning, what is told in this perspective may or may not occur. And then signature, place and date. Right? Then towards the end you have the signature, place and the date. Okay. Right, so that's your prospective financial information. Okay, right, so SAE 3400, right? So I'll not discuss as such 3402 and 3420, but just no harm in looking into the titles of them. Right, 4400 and 4410. We just look into the title so that we are set for our discussion in the next session. Okay, right. Now 3402 is applicable to the service auditor when my client is using the services of a service organization. And when the service auditor has to give a TOC report, this TOC report could be a type 1 report or it could be a type 2 report. In 810 you had 810 you had the applied criteria. In 3400 you had the assumptions. Now in 3402 you will have the suitable criteria, right? The suitable criteria. 3420, it is regarding the assurance engagement to report on compilation of pro forma financial information. Oh my God. And a pro forma financial information included in the prospectus. Right? So pro forma financial information included in the prospectus. Right? So here first we have to understand the concept of the PFFI. So SAE 3400, what we had? 3400, we had prospective financial information. Now 3420, we have the pro forma financial information. Now for pro forma financial information, we have to check the acceptability of the applicable criteria. So in 810, we had applied criteria. In 3402, we have suitable criteria. And in 3420, we have the applicable criteria. I am not making the terms on my own. I'm telling you what is given in the standards, right? In 3400 and 3420 CA, you are going to give the reasonable assurance. And you know, reasonable assurance is always given in the form of a positive assurance. But 3400, moderate assurance, negative assurance. But 3402, 3420 is the reasonable assurance engagement, but it is assurance engagement other than audit or review. It is assurance, but it is other than audit, review, assurance engagement. Okay. 4400, 4410, no assurance. And there it is no assurance, right? It is neither an audit nor a review, no assurance is given. Do you need to comply with the ethical requirements? Yes. Independence is voluntary. Why it is voluntary in case of related services? Independence is voluntary in case of related services engagement. Why is it voluntary? Because no assurance, no. When you are required to be independent, when you form an opinion, here you are not giving any opinion. You are saying no assurance, neither an audit nor a review, zero. No assurance is being given. In 4400, you are appointed to give a report on the, yes, you have to do the agreed upon procedures, AUP. We call these procedures as the AUP, agreed upon procedures, and the report issued at the end of these agreed upon procedures is called as the report of the factual findings. Report of the factual findings. And in 4410, you are appointed to assist the management in the preparation of financial statements. Generally, what do we say? Preparation of financial statements, whose responsibility? Management. But here we are going to assist the management in the preparation of financial statements by applying our accounting and financial reporting expertise. Right? Accounting and financial reporting expertise. What is the report called as? Accountant's report on the compilation of unaudited financial statements. Right? So 4400, what is the title? Engagements to perform agreed upon procedures regarding financial information. What is 4400 title? Engagements to perform agreed upon procedures regarding the financial information. And 4410, small name, compilation engagements. Right? Compilation engagements. You understand? So let's just, to conclude for today, let us tell the title of these 10 standards that we studied. 800, special considerations, audits of financial statements prepared in accordance with special purpose framework. 805, special considerations, audit of single financial statement, specific element, account or item. 810, engagements to report on in summary financial statements, right? Engagements to report on summary financial statements. 2400, engagements to review historical financial statements. 2410, review of interim financial information performed by an independent auditor of the entity. 3400, examination of prospective financial information. 3402, assurance report on controls at a service organization. 3420, assurance engagement on the compilation of pro forma financial information included in the prospectus. 4400, engagements to perform agreed upon procedures regarding financial information, and 4410 is the compilation engagement. Right. So what is your task for the rest of the day? Whatever we've studied today, you further look into it, revise it, and what we are going to study tomorrow, you just come with a realization that you don't know it. Right? So you read it and come. Right? So we start our day with DA, that is digital auditing and assurance. Then we do ethics and CARO clauses. Right? Then we complete with a few standards, and then we look into chapters of, like, say, NBFC and the group audit. Right? So see you tomorrow. Bye. Bye.